Welcome to this explainer. Okay, today we are going to completely dismantle a massive, and I mean absolutely massive, misconception about money. If you've ever caught yourself thinking that a high salary is just your automatic golden ticket to wealth, you're going to want to pay super close attention to this. Today, we're unpacking the exact strategies the wealthy use to build true independence. We'll look at how you can apply what's called the delay trick to seriously accelerate your own financial freedom. Let's just get right into it.
Okay, let's dive into this. 'Cause think about it. This is the great paradox of our modern working world. If a high salary makes you rich, why on earth are so many high-earning professionals totally broke? We literally see corporate earners bringing in thousands and thousands of dollars every single month, yet a shocking number of them are living paycheck to paycheck. They're trapped in this cycle that just feels impossible to escape.
Section 1, the high income illusion. Look, salaries definitely keep you comfortable, right? But here's the catch. Because you're trading finite time for money, your salary has a hard mathematical limit. And this brilliantly illustrates the fundamental difference in how these two groups treat their time. Average earners, they're capped by the 24 hours in a day. Even if you hustle and work incredibly hard, your active income is eventually going to hit an invisible ceiling. The wealthy, though, they're playing an entirely different game. They never trade time for money. Instead, they focus all their energy on building automated asset streams. They own things that work without their physical presence, generating cash flow literally while they sleep. It's a complete shift from raw effort to real leverage. Now, you might be thinking, but more money is always better, right? Well, notice how a high income can actually create a sense of fake security. If your expenses simply rise to match your new earnings, you're still financially stuck. Sure, you might be living in a much nicer house or driving a flashier car, but on a balance sheet, your control over your cash flow hasn't actually improved at all. Earning more money doesn't help one bit if your habits automatically drain it right back out. Which brings us to Section 2, the lifestyle inflation trap. This leads us perfectly into the psychological systems that are quietly draining our bank accounts. And the most dangerous of these traps, that would be lifestyle creep. Here's exactly how it happens. As your income rises, say you finally land that big promotion or a new job, your spending instinctively follows right behind it. Better cars, larger homes, just constant lifestyle upgrades. You might feel like you're absolutely winning at life because, well, your surroundings look successful. But quietly, you're ruining your success by expanding your liabilities instead of your assets.
In fact, let's just quickly fire off the 3 major psychological traps keeping people broke. Number 1. Lifestyle inflation, which we actually just covered, where earning more automatically triggers spending more. Number 2, social comparison. This is buying status to impress others. Essentially, it's spending money you don't really have to show off what you lack. And number 3, instant gratification, choosing short-term comfort over future growth. These traps are incredibly subtle, but they quietly force you to surrender your future potential. The contrast between those who fall for these traps and those who don't is honestly striking. The fake rich buy depreciating luxury cars the absolute second they get a raise. They buy status incredibly early because they want to look successful, literally trading their hard-earned capital for steel that loses 20% of its value the moment it drives off the lot. The invisible rich, on the other hand, they hide their wealth. They drive simple, reliable cars. They treat cash as a tool to acquire silent, productive assets, and they buy status last. They are choosing freedom over appearance every single time. Moving on to Section 3, the wealth gap strategy. So, what does this all mean? How do we actually transition from the fake rich to the invisible rich and finally break that paycheck-to-paycheck cycle? Well, the crucial point is right here in these 3 simple steps. Step 1, you get a salary raise or increase your income. Awesome. Step 2, and listen, this is where most people completely fail. You maintain your current living costs. You absolutely refuse to upgrade your lifestyle. Step 3, you invest the entire salary difference. You take that newly generated cash flow and redirect it straight into investments. Just think about the empty space between your flat, low expenses, and your new higher income. That space right there, that is the wealth gap. And that gap builds massive wealth. Undirected money disappears very fast. It just slips right through your fingers. But by intentionally keeping your expenses flat, you capture that entire gap and put it to work for you. To really hammer this home, you must delay lifestyle upgrades after raises. Maintain your current living costs, invest the entire salary difference, and keep your expenses flat for longer. Spending every raise immediately just stops your progress cold. The actual sequence of the wealthy is to invest the raise first, let it build those automated cash streams, and then, and only then, upgrade their standard of living much, much later, using the returns generated by their assets, not their active day-to-day labor.
And that brings us to Section 4, accelerating your freedom. Once you've actually created that gap and started investing the difference, you unlock the final piece of the puzzle. It's about visualizing exactly how that invested gap snowballs over time to quite literally buy back your life. See, the force that builds wealth the fastest isn't a massive high income, and it certainly isn't lucky market timing. No way. It is pure, uninterrupted time acting as your ultimate leverage. We call this compound interest. You invest your initial capital, that wealth gap we just talked about. That capital earns steady returns, and then those returns earn more returns. It's growth that feeds on itself. You just have to sit back and let compounding accelerate your freedom.
Let's move to see how this builds across a timeline. In year 1, honestly, the growth starts deceptively slow. Early compounding looks almost invisible, and frankly, this is where average thinkers usually quit. But over a decade, it accumulates mass like a giant snowball rolling downhill. By the time you hit 2 decades, the growth explodes vertically. It no longer grows linearly, it grows exponentially. By playing the long game, your financial independence becomes mathematically inevitable.
Okay, to make this super concrete, let's calculate your ultimate exit number. Financial freedom is pure math. It's actually really simple. Take your total monthly expenses and multiply them by 12 to get your yearly cost. Got it? Now, multiply that yearly cost by the number 25. That result, that is your freedom number. That's the target capital required to sustain you forever. Once your compounding investments hit that exact number, you literally never have to work a mandatory day in your life again. Clarity drives action, so take a minute to figure out your number today. I want to leave you with this profound thought to close out our explainer today. Real wealth is unspent cash. It is assets, not liabilities. Real wealth is invisible. It's the options, the security, and the time you've managed to purchase for your future self. So I challenge you. Look at your next raise not as an excuse to buy a flashy new car, but as a chance to literally buy your own freedom. Take control of your wealth gap, stay consistent, and let compounding do the heavy lifting. The real question is, what are you going to do with your next raise? Thanks for joining me on this explainer, and I absolutely can't wait to see you build your financial future.